Hello everyone, Greg Diamond here, editor of 10 Stock Trader Stansberry Research with another edition of Diamond's Edge Trader. And this week I'm going to be looking at something that I really have been calling since the last Federal Reserve meeting, that the Fed has made a mistake. And we can see that, I'll jump right into this here. We can see that, okay, right after the Fed cut rates back in mid-late September. All right, this is a chart of the US 10-year interest rate. And you can see I marked with this blue line, ever since the Fed cut the federal funds rate, everything else has gone up, right? The 2-year, 10-year, 30-year, they've all spiked higher. Now, what does that tell you? The bond market, interest rate market often discounts what's going to happen in the future. In this case, they're saying, I think you made a mistake. Now, technically speaking, you can see here down in the composite index, I have this positive divergence with this new low. This suggests, this was as of last week, that we'd see continued higher prices, and sure enough, or higher interest rates, and that's what we've seen. Something that I pointed out to 10 Stock Trader subscribers this morning in my weekly market outlook is the long-term look at interest rates. All right, so if we go all the way back to the late 70s and 80s, you can see here on the left-hand side of the chart, I've marked this lower high, and we had this 40-year downtrend in interest rates. That was the normal. All right, now if you zoom in here, okay, we broke in the downtrend. We broke above it back in 2022 when inflation was a big deal, when the Fed started, its long-term hiking cycle. All right, it retested the lows, and then broke out again. So this, and if you wanted to do the same thing that I did back in, in the early 70s or late 70s, early 80s, you could do something like this where you have, all right, here is the low, okay, and then we have a, this new trend. So just like we had this, this made the low, and then we have this higher low. You could do the same thing here, right? This started the new downtrend. This is starting the new uptrend. All right. So again, it doesn't, and we saw big spikes within this 40-year period, right? It's not to say that interest rates are going to continue to go straight up. Okay, big, but the overall downtrend was intact for 40 years. All right, will the new uptrend be intact for the next 40 years? I hope not, but it's definitely going to be a new paradigm where the new norm of lower inflation all the time, lower rates all the time, lower mortgage rates all the time is not necessarily going to be the case. And I think the Federal Reserve is stuck between a rock and a hard place, because if they hike rates again, because interest rates are actually rising, the market itself, what do they risk? They risk suppressing the jobs number. If they keep it low, right, if they start cutting, they already cut 50 basis points. If they do that again, which I don't think that they'll do, which again, I think the market is starting to price in with higher rates. But if they start cutting rates again to try to stimulate job growth, well, guess what? Then you run the risk of higher inflation. And it hasn't gone away in terms of the real inflation that everyday Americans see. If you go to the grocery store, you see it. Yeah, I don't need to get into that. Everyone knows how bad inflation has been. But this is the problem that they're going to have, and it's stagflation. Let's look at the jobs report from last week. 250 versus 125. It was a blowout report. Everybody thought it was great. Well, if you actually look underneath the hood of that jobs report, you saw a record number of government jobs, which is not private, and then you saw multiple people holding multiple jobs rise to new highs. So it's not all rosy from what we can see from that data point. But if you also look at the long-term trend from what happened, and I can pull that up. Let me pull that up right here. I'll show you. All right. So let's look at the non-farm payroll overall trend, and basically what we can see is that we had a good report, okay. It was 254 versus 150 were the expectations. But I really want you to see the long-term trend here in terms of what we're looking at regarding jobs, and then as it relates to inflation, okay. So, we saw this bump higher. This is back in, obviously after the COVID nonsense, okay. We saw this bump, basically everything that was closed down, it just reopened again. It's not like these new jobs were created. It was just a reopening of the economy. So look at the downtrend, even with this 254, which still couldn't break above this one back in March. We are in a technical downtrend in terms of what jobs are doing. So if this trend continues and we have this long-term downtrend where job creation is low while inflation remains high, we are looking at a new normal, as I told 10 stock trader subscribers this morning. So, again, this doesn't mean that we're going to see, a one-way freight train higher and lower. There's going to be good reports, there's going to be bad reports, but the long-term trend is there. Being short bonds is going to be something, on a long-term outlook that's probably going to be profitable. It doesn't mean that stocks are going to be in this 1987 like or 1929 like crash. That's going to ebb and flow as well. Something to point out again this week is the CPI on Tuesday and PPI on Wednesday. If those start to come out hot, guess what? The market is going to start discounting again that the Fed really made a mistake. Interest rates will start to rise, and that should have short-term pressure on stocks because they're not anticipating what the bond market has been. So a few things to think about there, but I'm obviously a short-term trader, but I also look at the long-term as well, and I found it very interesting to see how, number one, the interest rate market started trading after the Federal Reserve cut interest rates, and then two, the only thing that has gone up is interest rates as jobs go down. So we could be looking at an environment where stagflation takes over.